primary trade lines. Let's talk about starting up a primary trade line and what a primary trade line is. So recently in the credit world, you've heard a lot of people talking about primary trade lines. And you've heard a lot of people saying, hey, go get primaries. Primaries is what you need. Primaries is the thing. Get you a primary. But what they're not telling you is the reality behind what they're saying. So, they tell you about AUs and they tell you how great AUs are. Then they come back and they tell you primaries. Primaries are great. So then they tell you primaries are better than AUs. So let's kind of get a quick understanding of what they are. An authorized user trade line is when someone else adds you to their credit account and as a user, and their credit activity reflects on you. You have no control over that activity. You have no control over the payments or anything. And it's just them adding you as an authorized user. A primary trade line is whenever you are the primary or the main person who owns the account and you are in control of the account. That's the only thing that primary trade line means. A trade line is anything that's reported to your credit report. So now that we know what these things are, yes, of course, a primary is going to weigh more in your credit score. A primary is going to hold more value on your credit score. And a primary is going to help you with establishing relationships with banks as well as building your credit report and getting approvals much quicker than AUs in a lot of situations. And if not, it's definitely going to have a longer lasting effect. Now, we're talking about primaries. What is the big misconception? The big misconception in primaries is that primaries are the same as consumer finance accounts. And consumer finance accounts are actually bad for your credit report in a lot of situations, especially for the long term. Whereas primaries, again, are going to be great for you for the long term. So what do I mean by consumer finance accounts? If you guys don't know, I'm talking about accounts like My Jewelers Club, New Coast Direct, Lagos Jewelry, Attractive Gems Jewelers, all of those accounts, Hutton Chase, Ox Publishing, any of those types of accounts. Any of those accounts where basically you just pay them to report a card to your report, and it's stuff that you would never buy if it wasn't for that account. It's poor quality jewelry, it's poor quality home goods, it's all these things that you would never really buy. And basically, consumer finance accounts are like vendor credit on the personal side, meaning that they're not issued by banks. They're just issued out by little small companies, and it's like going to a buy here, pay here car dealership for your credit. So that's basically the breakdown on consumer finance. Now, the next cards that you want to avoid, and you've probably gotten some of these offers in the mail before, are subprime lenders. If you can avoid them, avoid them. These are going to be your cards like the Credit One Bank card, the Indigo card, the Merrick Bank, all of these, cards that they have a high annual fee and no rewards. So you're paying, $100 a year or $89 a year, for a card to keep an account open, and the card doesn't even have a rewards program, or you've never heard of that bank, or you've heard of that bank, but you haven't heard good things. Those you want to avoid as well. Now we're going to start getting into the types of cards that I recommend you building your credit profile with. And even with these, there are pros and cons to each one of them. And I'm going to lay them out very well for you guys. So you have store credit cards. These cards are typically issued by larger banks. However, you have to be careful with store credit cards because, yes, they are revolving lines of credit. They're just like any other credit card. But you have to make sure that when you're using these store credit cards, you're actually getting all of the benefits out of them, and that you're not applying for too many store credit cards at one time, because that can be looked at as risky behavior. So you hear the shopping cart trick a lot. The shopping cart trick does work, but you have to make sure that if you're going to do the shopping cart trick, that you're also going to do it for cards that you're actually going to use and are going to be benefits to you. And you're not just getting a trade line to add it to your report and leave it there, and it's not going to ever be of any benefit to you. The next type of cards are going to be secured cards. So now secured cards are credit cards that are issued by banks. Once again, issued by banks. And typically you're going to get a secured card for one of two reasons, either to build your credit or to establish a relationship with a bank. So those are the only two real legitimate reasons for getting a secured card: to build your credit or to establish a relationship with that bank. Many secured cards have limits as low as $200. Capital One has a secured card that even goes down to $50. And you can use these cards to build up your credit report. So you can say, okay, I want to get, a secured card with Capital One. I want to get a secured card with Citibank, with US Bank, and, or with Discover, and I can build my relationship with that bank while I'm building my credit at the same time. You put down basically a secured card. You're going to put down a security deposit. And once you put down that deposit, most secured cards now will refund that deposit after a designated period of time, typically 6 months. And then they will unsecure that card and allow that card to actually turn into a unsecured credit card through that same issuer. So again, a secured credit card is when you're loaning yourself money. A unsecured card is when the bank is loaning you money. And you have to check your secured card to see if it graduates or upgrades. Try to check that out with the bank before you apply for that secured card, even though terms can and will change in credit card policies. But if you're able to get a secured card that graduates, it's always great, like the Discover It Secured or the Navy Federal Secured, the Citi Secured. All these cards where you can put down your money. You can put down, per se, $200. Let it sit on that credit card, keep low utilization or no utilization for 6 months, and wait for them to unsecure that card, give you your money back, and then give you a higher limit. And then, of course, the last method that I'm going to give you guys last option I'm going to give you guys as far as a primary account, and probably the best option if you can get approved, is a starter card or entry-level credit card. So most issuers have a starter card. Chase has the Freedom. Discover has the It. Bank of America has the Bank America card. With Navy Federal, any of their cards other than the flagship. Basically, and typically, starter cards are going to be a card that they will approve you for with little or no credit. Go to your bank, ask them if they have a starter card, and see if you can get into that starter card or that credit builder card, and use those cards to your advantage when working on building your credit and adding primaries to your report. So as always, thank you guys, and we'll see you in the next video. Drop a comment down below and let us know what you think about the video, and what process or what part of your credit building journey you're in and what you like to see.